Welcome to ZZ Financial. We are committed to providing the most accurate, valuable, and timely information and analysis.
Good evening, everyone. It's Monday, September 1st. It's late night here, 11 p.m. Eastern Time, or 8 p.m. out on the Pacific Coast.
And we've just wrapped up a day packed with fascinating financial headlines. Honestly, some of these might even surprise your local fishmonger.
That's probably true. We've got shifts in global trade, some really cutting-edge AI transforming banking, and yeah, even some news hitting the dinner table. There's a lot to unpack.
There really is.
Yeah.
I'm genuinely eager to understand what it all means for us because sometimes these seemingly separate pieces of news, well, they connect in surprising ways, don't they?
Absolutely. That's what we're going to do in this deep dive. Explore how these global political shifts, the tech advancements, the localized economic pressures, how they're all shaping market trends and, our daily lives.
Okay, so we'll look at the ripple effects of U.S. tariff policies on Japanese industries.
Yep. And the swift adoption of AI and digital currencies in finance.
And you promised why my seafood might cost more this autumn.
We'll get to that, too. Our mission really is to connect these threads into a coherent financial story, help you see the bigger, more intricate picture.
Geopolitics to dinner plates, that's quite the range. I'm really curious to see how these seemingly disconnected pieces fit together. So to start our global market pulse check, where's the most impactful place to begin today?
Let's begin, as we often do, with the currency markets, specifically the Japanese yen.
Okay.
Right now, the yen is trading in a pretty tight range, sort of hovering around 147 per dollar in Tokyo.
Seems stable on the surface then.
Well, yeah, on the surface maybe. But underneath, there are these significant global factors, everything from interest rate differences to political uncertainty that are constantly pulling and pushing on it. It's far from calm.
Okay, so the yen is around 147 yen to the dollar. Now, I recently heard about Mrs. Watanabe and her contrarian strategy, and that she actually lost money last month.
Mrs. Watanabe, yes.
It makes me wonder, does that mean the market is really unpredictable right now? And what exactly is a contrarian strategy in currency trading? And who is this mysterious Mrs. Watanabe? Anyway, is she even real?
Haha, fantastic questions. And Mrs. Watanabe is, well, she's a fascinating, almost legendary figure in the Forex world.
Okay.
It's not a single person, though. It's a term used to describe Japanese retail FX investors, individual traders. They're known for their collective influence on currency markets. Think of them as a large, often pretty savvy group.
Got it. So a group of retail investors and the contrarian strategy.
Simply put, it's when you intentionally go against the prevailing market trend.
So if everyone's selling, you buy.
Exactly. Or if everyone's buying, you sell. You're betting that the market sentiment is wrong, or maybe that the asset is undervalued and due for a rebound. You're basically trying to outsmart the crowd.
So they're trying to buy low and sell high, but in a way that's intentionally opposite to what the crowd is doing. That sounds incredibly risky, like trying to catch a falling knife.
It absolutely is risky, and that's where the unpredictable part you mentioned comes in. Contrarian trading carries inherent risks, especially during sudden, unexpected market shocks, things that fundamentally shift perceptions.
Like what?
Well, take the employment shock we saw back on August 1st. Remember the July U.S. employment statistics release?
Vaguely, yeah. The numbers were revised down, right?
Significantly revised downwards. And that news wasn't just data, it was a kind of macroeconomic pivot point. It caused a rapid surge in the yen. It went from the high 150s all the way to the low 147s very quickly.
Wow.
So many Mrs. Watanabes, who had been employing a contrarian yen-selling strategy, betting against the yen strengthening.
We got caught out.
Exactly. They found themselves taking significant, swift losses. It's not just about market unpredictability, it's a stark reminder of how even savvy retail investors, using what seem like logical tactics, can be caught flat-footed when these powerful, policy-driven macroeconomic shifts fundamentally reprice an asset. Yeah, it really underscores the limits of tactical plays against those strong fundamental forces.
So it sounds like even for savvy contrarian traders, fundamental shifts, like those employment stats, can really upend a strategy that relies on market sentiment being wrong. It's a high-stakes game, especially when you think about the individual investors behind Mrs. Watanabe.
Definitely.
But despite that inherent risk, there must be some powerful incentive drawing many investors to these dollar-yen positions in the first place, right? What makes them keep coming back, even with the volatility?
You've really pinpointed a crucial aspect there. The primary draw for many medium to long-term investors, including segments of Mrs. Watanabe, is the attractive swap points.
Swap points, explain that.
Okay, so swap points basically reflect the significant interest rate differential between the US and Japan.
The rate gap.
Right. If you hold a long dollar position against the yen, you essentially earn interest on the dollar part at the higher US rate while you pay interest on the yen part at Japan's much lower rate.
Okay.
That difference, the net interest you earn, is the swap income. It can be quite appealing, offering a consistent yield.
How appealing are we talking?
Well, for instance, swap points have recently been around, say, 160 yen per 10,000 currencies daily. Now, that's lower than the 230 yen we saw during the peak of the Fed rate hikes, but it's still a substantial incentive. It makes these dollar-yen carry trades attractive for those looking for yield.
That makes sense. So it's a yield play, despite the FX risk. But speaking of risk, I also heard some buzz about former President Trump dismissing a Fed governor. Cook, was it?
That's right, Governor Cook.
That sounds like a move that could shake confidence in any currency. How does something like that, pure U.S. politics, factor into the yen's movements? It seems kind of indirect.
Well, here's where it gets really interesting, and it touches on the psychology of markets. The impact of former President Trump's dismissal notice to Governor Cook. It actually raises significant concerns about the Federal Reserve's independence.
The Fed's independence. Okay.
Any perceived political influence on monetary policy can erode confidence in the dollar globally. Investors might start to view such actions as a move towards, let's say, emerging market-like monetary policy.
Where politics drives decisions more than economics.
Precisely. Where political considerations, rather than pure economic fundamentals, seem to drive decisions. And that kind of uncertainty, that question mark over institutional integrity, tends to increase demand for perceived safe haven assets.
Like the yen.
Sometimes, yes. Even with its own internal dynamics, the yen can benefit from that flight to safety. It's often the perception of risk rather than just the risk itself that really moves markets in these situations.
So it's not just economic data, but even the perception of political meddling that can sway currency markets. Fascinating. So with all these complex forces at play, what's next on the horizon for the yen? What should we be looking out for that could potentially shake it up again?
Absolutely. Sentiment and perception are huge. For upcoming catalysts, you'll definitely want to keep an eye on the August U.S. employment statistics. They're due out on September 5th.
Always a big one. Always. That data often triggers significant short-term movements as traders react. Beyond that, BOJ Deputy Governor Humino's speech that's happening today, September 2nd, will be closely scrutinized for any clues about the Bank of Japan's monetary policy stance.
Okay, so U.S. jobs and the BOJ. But is the yen likely to just shoot off in one direction?
Well, here's the interesting twist. Even with these potential catalysts, most analysts believe that sustained one-sided trends in the yen are less likely.
Why is that?
It's precisely because of those active retail FX investors we talked about, the Mrs. Watanabes. They tend to engage in reactive contrarian trading. They effectively curb sharp, prolonged movements by betting against the prevailing trend once it seems to go too far too fast.
So they act as a kind of brake on big moves.
In a way, yes. A counterbalancing force.
That's a lot of moving parts for the yen. It really highlights the tug-of-war between global forces and local market dynamics. Let's pivot to Europe for a moment. I heard European stocks, like the Saison 600 and the DAX, saw gains recently.
They did. So if the U.S. is facing these political and tariff concerns, what's making European stocks do better? Are they just suddenly more appealing, or is there a bigger story here?
It's not necessarily about being better in some absolute sense. It's more a complex interplay of factors that make them an increasingly attractive alternative right now. European markets, including the Stoxx 600, Germany's DAX, France's CAC 40, and the UK's FTSE 100, did indeed see gains on September 1st. They rebounded from previous declines.
Okay.
And this isn't just a random bounce. There's some real underlying strength and, importantly, a strategic reallocation of capital happening. It's driven by both specific industry performance and a global search for diversification.
Okay, that sounds promising. What specific sectors are driving this rally? Is it across the board or just a few standout areas?
Well, a few sectors are particularly strong and are really acting as engines for this rally. Healthcare is a big one.
Healthcare, okay.
For example, the Danish pharmaceutical giant Novo Nordisk saw a significant surge. They announced positive drug data on its obesity treatment showed it substantially reduces heart attack risks.
Wow, that's huge.
It is. That's a massive win, not just for the company, but for the sector, signaling innovation and strong demand. Defense and aviation are also performing remarkably well.
Right.
Companies like Rolls-Royce Holdings in the UK, the aircraft engine maker, and the German defense contractor Rheinmetall are seeing strong buying interest. These sectors are maybe less directly exposed to some of the immediate U.S. political and tariff uncertainties, offering a degree of insulation.
So it's targeted growth. But
Yeah.
you mentioned a reallocation of capital.
Mm,
Are investors literally pulling money out of the U.S. and putting it into Europe? That seems like a pretty bold move.
That's exactly right, and it's a tangible trend we're seeing in the data. Investor caution regarding U.S. stock investments, particularly due to the Trump administration's ongoing tariff policies and the resulting uncertainty. It is leading to a noticeable shift of capital.
How noticeable?
Well, look at the EPFR data for the first half of 2025. It illustrates this clearly. European stock funds saw net inflows of $42.5 billion. That actually surpassed U.S. stock funds, which received $32.1 billion.
Wow, first time in a while.
It's the first time since 2021 that European funds have seen a net surplus for that January-June period. It's a concrete reflection of investors actively seeking more stable or perhaps less politically exposed opportunities. They're looking beyond the traditional U.S. dominance.
That's a significant shift. Are you seeing this pattern reflected in Japanese investment as well? I mean, Japanese investors have historically had a strong appetite for U.S. stocks, right? So a change there would be particularly telling.
Indeed. And yes, even Japanese asset managers are making strategic moves, signaling a broader reevaluation of global portfolios.
Very cool.
Firms like Nippon Life Insurance affiliated asset managers and Rakuten Group affiliates are launching new European stock index funds. This marks a notable shift away from their previous heavy reliance on U.S. stocks, which has long been a staple for Japanese institutional investors. These new funds are tracking indices that include major European names.
Such as?
Think ASML Holding in the Netherlands, the semiconductor equipment giant, or Novartis, the Swiss pharma company. You've also got SAP, the German software powerhouse, and the UK's AstraZeneca.
Big names.
Definitely. It signals a broader global trend of diversifying away from a concentrated U.S. equity exposure towards European opportunities, driven by both performance and, frankly, political hedging.
It sounds like Europe is presenting a compelling narrative for diversification and growth right now, especially for those looking to de-risk from U.S.-centric political uncertainties. But what about European government bonds? Are they also seeing this kind of positive momentum, or is it a different story there?
That's where we see a bit of a cautious undercurrent, even amidst the equity gains. Despite the rebound in European stocks, government bond yields in countries like Germany, France, and the UK are actually rising.
Oh, okay. Why?
It's primarily due to persistent fiscal and political uncertainties within Europe itself. This creates a divergence between equity and bond market sentiment. For example, concerns about France's political and fiscal outlook may be coupled with Germany's plans for increased defense spending that's creating selling pressure in the bond market.
So stocks are finding footing, but bonds are reflecting some underlying worries.
Exactly. The bond market echoes a more cautious sentiment, reflecting that underlying fiscal health and political stability remain a concern for investors in government debt, pushing those yields up.
So European stocks are up, but their bonds are struggling a bit. That's a complex picture, showing investors are getting very selective. Let's bring it back to Japan for a moment and specifically look at their bond market. What's happening there, especially with all this talk of rate hikes from the Bank of Japan?
Yeah, Japan's bond market is bracing for a potential decline, meaning rising yields, probably starting today, September 2nd. It's influenced not only by those global trends we just discussed, but also by domestic monetary policy speculations surrounding the Bank of Japan. It's a pretty critical day for Japanese bonds.
What's pushing on Japanese bonds from the global side? Is it directly related to what you just said about European bonds?
Precisely. We're seeing a clear global contagion effect. Those rising government bond yields in Europe, driven by the fiscal and political concerns, are putting upward pressure on Japanese bonds.
Even with the U.S. market closed yesterday.
Yep. Even with the U.S. closed for Labor Day, the selling in European government bonds, particularly German and French ones, creates a ripple effect. This leads to selling pressure on domestic bond futures in Japan. Investors anticipate that global yield increases will inevitably pull Japanese yields higher too, even if the BOJ's policy remains distinct for now.
So Japan's bond market can't escape the gravitational pull of other major economies. And then there's the Bank of Japan, the BOJ. I know they've been pretty dovish for a long, long time, but is that changing? What's the sentiment around their stance on potential rate hikes?
The BOJ's stance is indeed under intense scrutiny, especially with Deputy Governor Jimeno Reyes' speech and press conference scheduled for today.
Right, you mentioned him earlier.
You might recall back in January, Jimeno hinted at additional rate hikes. He said the policy board would discuss and decide whether to raise rates.
That sounds like a shift.
It sent ripples through the market because it broke from that historically ultra-dovish tone. So if he indicates today that Japan's underlying inflation rate continues to rise toward the BOJ's 2% target, it could certainly weigh on the bond market. It suggests the possibility of another rate hike sooner rather than later is increasing.
So even a hint could cause a stir. But is the market actually expecting a significant early rate hike from the BOJ, or is it more of a speculative wait-and-see situation?
It's more nuanced than that. Many market participants believe that a significant early rate hike is, well, unlikely.
Why is that?
The BOJ needs time. They need to assess the full impact of U.S. trade policy on Japan's economy and prices, given all the global uncertainties. This cautious approach means that while Jimeno's comments are important, the market might not immediately price in a drastic shift unless he's explicitly hawkish.
Is there a way to measure that market expectation?
Yeah, a good gauge is the overnight index swap market, an OIS market. It's often considered a cleaner gauge because it's less influenced by credit risk than other derivatives. Right now, it's pricing in about a 50% probability of a rate hike by October.
So 50-50. Partial anticipation, but not full conviction.
Exactly. Not full conviction for immediate aggressive action. A lot of uncertainty still lingers.
Okay, so it's a delicate balance of global contagion, BOJ's evolving stance, and a market that's only partially convinced of immediate aggressive action. And what about the actual buying and selling of bonds today? I heard something about an auction.
Yes, that's the immediate litmus test for the market sentiment today. The Ministry of Finance is conducting a 10-year bond auction, a substantial one, $2.6 trillion.
And normally, high yields would attract buyers, right?
Normally, yes. But despite current yield levels being relatively high, there's a strong possibility that investor demand could be, well, sluggish.
Because of those rate hike expectations.
Precisely. Investors might hold back, anticipating even higher yields in the future if the BOJ does indeed tighten policy. If demand at the auction is weak today, it could push yields even higher, reinforcing the market's current downward trend for bond prices. It could set a very clear tone.
Right, so we're looking at a market grappling with global pressures, domestic monetary policy speculation, and an upcoming bond auction that could confirm or challenge current expectations. That paints a pretty clear picture of volatility and careful positioning.
Exactly.
So that's the global market pulse. Let's shift our focus now to corporate Japan. What innovative strategies are they adopting to navigate these global demands, especially around things like sustainability and new technology?
Corporate Japan is definitely adapting, and in some very interesting proactive ways. We're seeing widespread responses to global demands for sustainability, rapid leveraging of advanced technology like AI, and a significant evolution in their financial infrastructure. It's truly a pivotal moment for many Japanese firms.
Let's start with sustainability, because I saw a report that 80% of major Japanese companies are linking executive pay to ESG. That's huge.
It is a very high number.
But what does it actually mean to link executive pay to ESG indicators? And why are Japanese companies doing this when I hear some Western countries are actually pulling back from similar initiatives? It feels like a global divergence.
That's a fantastic observation, and it really highlights a striking divergence in global corporate governance trends. When we talk about linking executive pay to ESG indicators, it means that a portion of an executive's bonus or their long-term incentives, like stock options, is tied directly to achieving specific goals.
The kind of go.
Environmental goals, like quantifiable greenhouse gas reduction targets, or maybe milestones in renewable energy use. Social goals could relate to human capital, things like diversity metrics or employee engagement scores. And governance goals might involve board independence or transparency initiatives. It's about moving beyond just the financial metrics.
So it's not just about hitting quarterly profit targets anymore. It's about hitting these broader societal and environmental targets too. What's driving this strong, almost uniform push in Japan specifically?
A major driver, A really powerful incentive is an upcoming regulatory change.
Oh, regulation.
Starting from March 2027, there will be mandatory disclosure of sustainability information for large Japanese companies in their securities reports. This looming deadline isn't just a compliance hurdle, it's pushing firms to accelerate their climate change responses and deeply integrate ESG into their core strategy, including how they pay their executives.
So they want to get ahead of the curve.
Exactly. Demonstrate their commitment to investors and regulators ahead of time, signaling long-term vision and accountability.
That's a powerful incentive. Are there any specific company examples doing this right now? It always helps to see how it plays out in the real world.
Absolutely. We're already seeing concrete examples. For instance, Disco, a major precision equipment manufacturer, plans to link short-term incentives to greenhouse gas reduction targets starting in March 2026.
Okay.
They explicitly cite investor demands and those upcoming regulations as their reasons. Asahi Kasei, a diversified chemical company, has similar plans linking short-term incentives to emission reductions from March 2026. These aren't just vague commitments, they're concrete, measurable targets tied directly to executive performance.
That's a really clear distinction. You mentioned Western countries pulling back. What's going on there? It's curious to see such different paths being taken.
It's a striking contrast indeed. While Japan is accelerating ESG integration, the trend of linking ESG to compensation has actually stagnated or even declined in some Western countries.
Really? Like where?
The U.S., for example, saw a 4-point drop, down to 70% of major companies doing this now. The U.K. also decreased by 3 points to 91%, still high, but a decline nonetheless.
Why the pullback?
It's largely attributed to anti-ESG sentiments, which have gained traction, possibly linked to political discourse, particularly around a potential second Trump administration. There's a pushback against what some perceive as woke capitalism, causing companies to maybe reevaluate their public stance on ESG, even if internal efforts continue.
So it's become more politically charged elsewhere.
Exactly. What's a clear imperative for Japanese companies is becoming a more complex issue elsewhere, creating this fascinating global divergence.
Wow, that's a big difference in approach. So while some are pulling back, Japan is leaning in. That makes sense, especially with those new disclosure regulations. Now let's talk about technology. I keep hearing about AI, but how is it actually being used in a bank? Is it just for customer service, or is it doing really complex financial work too? And critically, how many hours can AI really save in a large organization? I mean, are we talking incremental gains or a revolutionary shift?
AI is rapidly transforming the financial sector, and it's far more than just customer service, though that's certainly part of it. The scale of projected efficiency gains is truly staggering. It really points to a revolutionary shift in how banks operate.
Okay, give me some specifics. What are the big players doing, and what kind of tasks are they actually handing over to AI?
Okay, take Mitsubishi UFJ Financial Group, MUFG, one of Japan's largest banks. They're making a multi-billion yen strategic investment in an AI startup called Layer X.
Okay.
Their ambition is truly impressive. They aim to reduce an astounding 200,000 working hours annually across 60 different use cases.
200,000 hours. That's like, what, 100 full-time employees worth of work?
Pretty much. It's about automating tasks that are currently very time-consuming for human employees, coaching them up for more strategic work.
Like what kinds of tasks?
Things like generating complex proposals for large corporate enterprises that often involves extensive research, data analysis, drafting. AI is also being used for drafting and meticulously checking financial contracts, reviewing customer documents for compliance, even searching through vast archives of past proposals to quickly create new PowerPoint presentations.
So it frees up staff for more complex things.
Exactly. More value-added activities like relationship building, bespoke problem solving.
That's a huge scope.
Yeah.
So it's streamlining the back office and middle office. What about customer-facing applications? Are we talking about AI taking over call centers or enhancing them?
Both, actually. Credit Saison, another major financial player, is planning to integrate AI into its call center operations by spring 2028. They're aiming for both automation and enhancement.
How will that work?
Well, the system is designed to provide automated voice responses, handle natural conversations, and even intelligently determine if a customer's issue needs human assistance or if AI can resolve it entirely.
Okay. And if a human is needed?
Then the AI acts as an intelligent co-pilot. It instantly summarizes the inquiry for the human operator and suggests appropriate answers, speeding up resolution times. And crucially, it also handles post-interaction tasks like organizing dialogue records, saving even more time.
So it's not just replacing, but enhancing human work.
Yeah.
And Is Credit Saison doing anything else with AI beyond the call center, or is this a company-wide initiative?
Oh, it's absolutely a company-wide initiative. They're actually rolling out AI across the entire organization.
All employees.
Credit Saison plans to give all 3,700 employees access to OpenAI's ChatGPT, not just specific teams. Their ambitious target is a cumulative reduction of 3 million work hours by the end of fiscal year 2027.
3 million hours.
Yeah, which is equivalent to about 1,500 annual labor hours compared to their 2019 baseline. This really underscores the broad, company-wide commitment to AI adoption.
That's a massive commitment. Is this just happening in Japan, or is it part of a bigger global trend in banking that we should be aware of?
It's definitely a global trend, and Japan is right there at the forefront. This aligns perfectly with what we're seeing in major banks worldwide. JP Morgan Chase, for instance, is reportedly using AI in over 500 cases.
500, wow.
Yeah, not just customer service, but highly sophisticated tasks like fraud detection, credit risk management, overall operational efficiency across its vast global network. So this rapid adoption in Japan is very much part of a major shift, fundamentally changing the operation and backbone of the global financial sector.
So AI is definitely here to stay in banking.
Deeply embedded in nearly every aspect, I'd say.
It sounds like it'll make banking both more efficient and perhaps more complex behind the scenes. Now, speaking of futuristic finance, let's talk about digital currencies. Wow, so Japan Post Bank is issuing its own digital currency, DCJPY.
That's right, a big move.
But what exactly are tokenized deposits, and how are they different from regular money in my bank account or even cryptocurrencies like stablecoins? It all sounds so futuristic, but also a bit confusing.
You've hit on a really key area of innovation, and yeah, it can sound quite complex. Japan Post Bank's decision to issue DCJPY in 2026 is significant for the future of payments.
So tokenized deposits. Break that down.
Okay, imagine your regular bank deposited money in your account. Now, instead of just being an entry in a bank's traditional ledger, it's represented digitally as a token on a blockchain.
Okay, so it's still my money in the bank.
Exactly. It's still fundamentally your money held in a bank, subject to all the same regulations and protections. But it exists in this new programmable digital format. The key here is stability. One DCJPY will always equal 1 yen.
Always one-to-one.
Right, ensuring its value is fixed and reliable. It offers the same convenience and security as traditional bank deposits, backed by bank security measures and, crucially, deposit insurance. That makes it incredibly stable.
So it's like a digital version of my yen, but on a blockchain. That sounds a lot like stablecoins, which are also supposed to be pegged to fiat currency. What's the difference then between DCJPY and a stablecoin? This is where it gets confusing for me.
That's a really important distinction, and the nuances matter significantly. While stablecoins are also pegged to fiat currency, they can, and sometimes do, experience price fluctuations. We've seen instances of depegging, right?
Yep, where they lose their value.
Exactly. Their value significantly deviates from the fiat currency they're supposed to represent, often due to issues with their backing assets or market stress. This makes their financial and accounting handling more complex for companies.
Okay, what else?
Additionally, stablecoins generally face higher difficulties in anti-money laundering, or AML, measures. And unfortunately, they have been exploited by criminal groups for illicit activities due to their often decentralized nature and sometimes less rigorous oversight.
I see. So DCJPY, being a bank deposit, inherently carries the bank's security and regulatory framework from day one. That sounds much more secure and trustworthy.
Exactly. With DCJPY, the rigorous identity verification and AML mechanisms already implemented by banks are maintained and integrated. It comes with bank-level security and oversight from day one, offering a far more robust regulatory environment than most stablecoins.
Plus, deposit insurance.
Yes, plus, being a deposit, DCJPY is covered by deposit insurance. That's a crucial layer of safety many stablecoins lack. However, there are some initial limitations.
Like what?
Currently, DCJPY is designed primarily for transfers between verified accounts within the same bank.
Not like stablecoins that can move anywhere.
Right. It contrasts with stablecoins' broader, often borderless circulation and use in decentralized finance. But this initial focused rollout allows for tighter control and security as they scale up.
Okay, that clarifies a lot. So it's a safer, more regulated digital yen, but with some initial usage restrictions. What about the broader regulatory environment for cryptocurrencies in Japan? Is the government getting more involved to bring order to this space?
Yes, the Financial Services Agency, the FSA, is indeed making a significant regulatory shift. They want to bring more clarity and protection to the crypto space.
Oh,
They plan to move cryptocurrency regulation from the Payment Services Act over to the Financial Instruments and Exchange Act, or FIEA.
why that move?
The why is crucial. It's to eliminate dual regulation. Right now, crypto businesses often have to comply with two sets of regulations, which creates an unnecessary burden and can stifle innovation.
Streamline it.
Exactly. By consolidating under FIEA, the FSA aims to reduce these business burdens while simultaneously strengthening user protection. This means clearer disclosure obligations for crypto issuers and exchange operators, ensuring investors have better information about risks.
Right.
They aim to submit an amendment to the diet in 2026.
So it's about making the regulatory landscape clearer and safer. Seems sensible for a new technology. And how are Japanese financial institutions adapting their funding strategies in this evolving financial world, especially with global interest rate shifts?
We're also seeing interesting strategic funding moves. Institutions are adapting to global market conditions. For instance, Fukuoka Mutual Life Insurance successfully issued $700 million in dollar-denominated subordinated bonds.
And that went well.
Extremely well. They achieved a record low spread, indicating strong investor confidence, partly due to expectations of Fed rate cuts, maybe, but it also reflects a broader trend of diversifying funding sources.
Others doing this too.
Yep. Nippon Life, for example, recently raised $500 million in euro-denominated subordinated bonds. They're expanding their funding beyond just dollars and yen to reach a wider international investor base. These moves highlight how financial institutions are constantly adapting their capital strategies, seeking optimal funding costs and broader investor reach.
Right, so Japan is really active in this digital financial transformation, new currencies, smarter regulations, adaptive funding. Let's shift gears again to something completely different, specific industries. What are some of the unique trends and policy debates impacting sectors from manufacturing to consumer goods?
Yeah, these sector-specific deep dives are crucial. They help us understand the ground-level impact of broader economic currents and policy decisions. We'll look at how capital investment is faring under those tariff threats, why your dinner table might look different, and a pretty heated debate over car taxes.
Okay, first up, Japan's corporate investment grew, which sounds great.
Yeah,
That implies confidence in future growth.
it does on the surface.
But then I hear about U.S. tariff policies and profit deterioration, especially for car makers. Can you explain that? It sounds like two very contradictory pieces of news. And does this mean that companies might stop investing if profits decline, like a car running out of gas?
That's a perfect analogy, actually, and you've hit on a critical point of tension and a classic economic dilemma. Japan's corporate capital investment did grow a healthy 7.6% in the April-June period. That's the second consecutive quarter of growth.
Okay, that's good.
On the surface, yes. Strong economic activity, corporate confidence.
That's definitely good news.
Yeah.
What industries are leading that investment surge? Is it widespread or concentrated in a few areas?
The manufacturing sector was a big driver, up a robust 16.4%. Within that, transportation equipment, mainly automobiles, surged an impressive 43.4%.
43%, wow.
Yeah. Food products also saw a significant boost, up 38.2%, driven by investments in enhanced confectionery capacity, believe it or not.
Okay. And the auto investments, mainly EVs.
Largely focused on strengthening electric vehicle production systems, yes. It indicates a commitment to the future of automotive tech. So it was targeted growth in key forward-looking areas.
Okay, so that's the good news, showing forward momentum. Now, what's the tariff cloud you mentioned? How are U.S. tariff policies directly affecting these Japanese automakers, especially when they're investing so much in things like EVs? It seems counterintuitive.
Here's the challenge, and it's a direct consequence of global trade tensions. U.S. tariff policies are hitting Japanese automakers significantly. To maintain their export volumes and price competitiveness in the crucial U.S. market, they're essentially forced to lower their export prices.
To absorb the tariff cost.
Pretty much. And this strategy directly leads to a significant decline in recurring profits, the profit from core ongoing operations. We saw this starkly in the transportation equipment sector. Recurring profits plunged by 29.7%.
30% drop in profits, just from that.
It's a direct consequence of trying to absorb the tariff burden to stay competitive. They're sacrificing margins to keep market share.
So they're cutting prices to get cars into the U.S., but
Yeah.
that's eating into their bottom line. And that car running out of gas analogy, does that apply here? If profits keep falling, will the investment engine just stall? Because you can't keep spending money if you're not making it, right?
Unfortunately, yes, that analogy is quite apt. It illustrates a fundamental economic principle. Capital investment tends to lag behind corporate profits.
Okay.
Companies invest when they're confident about future earnings and have the financial means. If profits continue to struggle or decline significantly, that confidence erodes. Investment momentum will inevitably slow down.
Are experts seeing signs of that already?
Yes. Experts like Tariffs from NLI Research Institute are pointing out that given the current profit decline in manufacturing, capital investment is expected to follow suit and slow down. Companies become more cautious, bracing for changes, which often means hitting the brakes on expansion plans.
That makes perfect sense. They can't keep spending money if they're not making it. And what about policy consistency? I heard about reviews of environmental regulations in the U.S. How does that add to the uncertainty for Japanese car makers, especially those who've invested heavily in, say, EV technology?
That's another major layer of uncertainty, and it's particularly frustrating for long-term planning. For companies that have invested heavily in EV compatibility, the Trump administration's review of environmental regulations, well, it might shift focus from pure EVs back towards hybrid vehicles in the near term.
Creating inconsistency.
Exactly. Policy inconsistency. Japanese parts manufacturers, for example, who spent years preparing for EV-specific components, now face a fluid and unpredictable policy landscape. This kind of unpredictability is a major problem for long-term planning and investment. Companies don't know which direction to commit their resources. It truly adds to that tariff cloud, making strategic decisions incredibly difficult.
So they're navigating tariffs, declining profits, and shifting policy winds. That's a tough environment to innovate and invest in.
Extremely tough.
Let's move from cars to fish, specifically mackerel. Oh no, not my grilled mackerel. That's practically a staple in my autumn diet.
I know the feeling.
But seriously, I heard our own catch has halved, and we're even using small fish for farm feed. It sounds like a fishy business, literally. Why aren't we catching enough for ourselves, and what's Norway's secret sauce for being so much better at this?
You're right to be concerned about your autumn dinner plate because mackerel prices are indeed expected to rise sharply. It's a story of global demand clashing with local mismanagement.
How sharp an increase.
Norwegian mackerel prices are surging by 60%. 60%. And this will absolutely be reflected in Japanese processed products from October onward. Prepare your wallet.
60%. That's massive. Why is Norwegian mackerel so expensive all of a sudden? Is it just a bad fishing season?
Not just a bad season, it's a confluence of factors that actually highlight smart resource management on Norway's part.
Okay, what factors?
First, strengthening global demand for high-quality mackerel, especially from Asian markets. Second, the weak yen makes all imports more expensive for Japanese buyers. But a major factor is stricter resource management by the Norwegian government.
What do they do?
They reduced their fishing quota by 20% compared to last year. To maximize profits within this limited quota, Norwegian fishermen are selectively catching high market value, large, fatty mackerel.
The good stuff.
Exactly. We're talking fish over 500 grams, about 30% fat content, precisely what consumers want. And here's the kicker. 99% of Norway's mackerel catch is destined for human consumption.
99%.
Maximizing its economic value, ensuring premium prices.
Wow, 99% for human consumption. That sounds like smart, targeted fishing that really understands the market. Now, contrast that with Japan's situation. Why has our domestic catch halved in 5 years? And why are we feeding so much of it to farmed fish? That seems like an incredible waste when prices are so high.
This is where Japan's dilemma becomes stark, and it's truly a tragedy of resource mismanagement. Our domestic mackerel catch has halved in just 5 years, a really concerning decline.
Okay.
And you're absolutely right. It's a huge problem that a staggering 60% of the landed mackerel in Japan is used as feed for farmed fish, like tuna and yellowtail.
60% for fish food. Why?
Because the mackerel caught domestically are often small, thin, and simply unsuitable for human consumption, typically under 200 grams. A truly sad figure is that only 10% of Japan's domestic mackerel catch is for fresh human consumption. The rest goes to feed or low-value processing.
So Norway catches big, fatty mackerel for people, and Japan catches small, thin ones for fish food. It sounds like a stark contrast in resource management. Why is Japan's approach leading to this quantity over quality outcome? Is it fishing methods or policy?
It's primarily about policy and the management approach, what some critics call the quantity over quality trap.
Explain that.
Norway sets strict quotas based on scientific resource surveys. This allows them to manage their stock sustainably and incentivize catching larger, more valuable fish. In contrast, Japan's fisheries agency, Well, they often prioritize the interests of sane net fishermen and processing companies. They set quotas that are frequently twice as large as scientific recommendations.
Twice as large why?
This approach leads to an overemphasis on catching any mackerel, even small ones just to fill the quota, often through indiscriminate fishing methods. It creates a vicious cycle.
How so?
Declining resources, an abundance of low-value small mackerel, and ultimately a reduction in fishermen's income because they can't fetch good prices, which then perpetuates the need to catch more volume, making the problem worse.
That's a really clear difference in strategy with direct consequences. So the Japanese consumer is getting hit twice, facing higher prices for imported Norwegian mackerel and reduced availability of fresh, good quality domestic mackerel.
Exactly. The reduction in domestic mackerel directly increases the burden on Japanese consumers. At Toyosu Market, for example, mackerel arrivals halved over the past decade, while wholesale prices for the dwindling supply rose by 40%. It's a clear, tangible example of how resource mismanagement impacts daily life and the consumer's wallet.
Turning a staple into a luxury. That's tough for seafood lovers. All right, let's switch gears one more time for this segment. So the government is arguing about a car tax.
Yep, a heated debate.
What is this environmental performance tax, and why is it so hard to decide whether to get rid of it? Doesn't everyone want cheaper cars, especially now with all the other economic headwinds?
It's a classic policy conundrum, balancing multiple competing interests, and you've hit the core tension. The automobile environmental performance tax is a local tax paid when you purchase a car in Japan. It ranges from 0% to 3% of the car's price, with the rate directly linked to the vehicle's fuel efficiency. The key here is that low environmental impact vehicles, like EVs, are exempt.
So it incentivizes cleaner cars.
Exactly. Its design has an environmental objective.
Okay, so it's designed to encourage greener choices. But if it's a tax, wouldn't reducing or abolishing it make cars cheaper? Which sounds like something the automotive industry would definitely want, especially with those U.S. tariffs impacting their profitability.
That's exactly the argument from the Ministry of Economy, Trade, and Industry Minute. They are strongly advocating for the abolition of this tax.
Why?
Their reasoning is twofold. First, reduce the tax burden on consumers, which they believe will encourage more car purchases and stimulate demand. Second, and crucially, provide direct support to the automotive industry, which is facing those significant headwinds. Minute sees this as a tangible way to alleviate pressure on manufacturers like Toyota.
And the car industry agrees.
Oh yes, the Japan Automobile Manufacturers Association has long argued for its abolition, claiming it constitutes double taxation when combined with the consumption tax.
That seems like a logical move from media's perspective, especially if it helps a key industry and consumers. But you mentioned other ministries are cautious. What are their counter-arguments? Who loses out if this tax is abolished?
This is where the complexity truly comes in. Removing this tax creates significant ripple effects. The Ministry of Internal Affairs and Communications, which oversees local taxes, is very cautious.
Why them specifically?
This tax generates approximately $190 billion annually, and all of it goes to local governments. For many regions, especially those heavily reliant on cars, this is a crucial and maybe irreplaceable revenue source. They're understandably asking, if you abolish it, how do we replace that lost revenue, especially when local budgets are already strained?
So local governments would definitely feel the pinch. What about the Ministry of Land, Infrastructure, Transport, and Tourism, MLIT? What are their concerns?
MLIT is also cautious, but for a different reason. While automobile taxes are general revenue, they're traditionally used for road maintenance and infrastructure development.
Okay.
With Japan's aging infrastructure and rising maintenance costs made worse by inflation and labor shortages, MLIT feels that abolishing this tax could lead to significant funding shortages for essential road upkeep. That impacts public safety and economic efficiency.
And the Ministry of the Environment. I can guess their concern, as this is an environmental performance tax after all.
You'd be right. The Ministry of the Environment is understandably reluctant to support abolition. They argue that because the tax incentivizes fuel-efficient and EV purchases by exempting them, removing it could significantly hinder Japan's decarbonization efforts and its ambitious climate goals.
It removes the nudge towards greener cars.
Exactly. It could slow the transition to a lower carbon economy.
So it's a tug-of-war between supporting industry, maintaining crucial local government revenue, safeguarding infrastructure funding, and pushing environmental goals. That sounds politically tricky, especially in the current climate.
It is incredibly complex. Beyond the interministerial disputes, both ruling and opposition parties are divided. Some opposition parties are eager for tax cuts ahead of looming elections, aligning with abolition. Others propose alternative taxes, which just shifts the burden.
So no easy consensus.
Traditionally, major tax reforms were finalized by year-end by the ruling parties. But under a minority government, cross-party talks are necessary, making consensus extremely challenging. It really highlights the difficulties in balancing fiscal health, industry support, and environmental commitments, especially when an election is on the horizon.
A truly multifaceted debate with no easy answers. Now, as we move into our final segment, let's zoom in on some micro trends that are having a macro impact, from startups transforming industries to the wild swings in commodity prices. These are often the hidden signals of where the economy is really heading.
Indeed, these are the specific company news, new business models, commodity market dynamics that reflect broader economic currents. They often provide fascinating insights, acting as bellwethers for larger shifts.
Okay, first one. I thought banks just helped with money. Why are they suddenly helping families with things like governance and family meetings? Is it just a sneaky way to sell them more investments later, or is there something bigger going on with family businesses in Japan? It feels like a very non-traditional banking service.
That's a great question, and it really highlights an evolving role for financial institutions, moving far beyond just transactions. While traditional financial services are still central, this shift towards offering non-financial services, like governance advice and setting up family meetings, it's a strategic response to a unique yet critical aspect of Japan's economic landscape.
What makes Japan's family business landscape so unique that banks are getting into family meetings? I mean, don't all countries have family businesses?
They do, but in Japan, it's particularly pronounced. A staggering 97% of Japanese companies are family-run, and about half of all listed firms also fall into this category.
97%. Wow.
Yeah. Now, many of these companies were established in the post-war economic boom. Their founders are now reaching the point where second and third generation successions are becoming critical. This creates immense demand not just for simple asset transfers, but for complex succession planning. It goes far beyond just moving money.
It touches on family dynamics.
Exactly. Delicate family dynamics, long-term business continuity.
So it's not just about the inheritance. It's about passing on the whole business and its values. And
Yeah.
that involves more than just numbers. That makes sense.
Precisely. Families need help with internal issues, establishing clear governance structures, understanding how to pass on the weight of being a major shareholder, not just the financial assets. As one family president of a real estate business put it, traditional wealth management stops at financial solutions. I wanted to consult on corporate governance conscious of the family.
So they need guidance on family charters,
Oh.
decision-making.
Yes, even fostering family cohesion during these potentially turbulent transitions. And financial institutions are stepping up. Mizuho Trust Bank assists with family charter creation and meeting operations. Sumitomo Mitsui Trust Bank is launching a comprehensive governance program for about 20 family companies this September.
That's a deep level of engagement, really getting into the intimate workings of these businesses. Are these financial institutions doing this completely on their own, or is there a broader recognition of this need from the government?
This trend is actually being supported by a national movement, underscoring its macro importance. The Ministry of Economy, Trade and Industry, MUTI, will formulate governance guidelines for family businesses within fiscal year 2025.
So MITI sees this as important too.
Absolutely. MITI recognizes that the continued health and growth of these mid-sized, often family-run firms are essential for Japan's economy. These guidelines are expected to drive further demand for related services, and financial institutions are positioning themselves. We even see international collaborations like UBS Sumi Trust Wealth Management offering global networking for inheriting generations. It's truly a cross-industry competition to offer services that go beyond financial thinking.
That's a comprehensive approach to supporting the backbone of Japan's economy. Recognizing the human element is just as crucial as the financial. Now let's talk about something everyone is always interested in: gold.
Ah, yes, gold.
Gold is at record highs, and some experts say it'll keep going up to $3,600, but others say it could fall back to $3,000. How can they be so different? What's driving these massive swings and this split opinion?
It's fascinating, isn't it? Gold prices in New York and London have indeed hit record highs, approaching $3,500 per troy ounce. And yes, expert opinions on where it goes next are sharply divided. It speaks to the many complex and often contradictory factors influencing the market.
So it shows how analysts can interpret the same data differently.
Exactly. It's a powerful illustration of how the same geopolitical events, the same economic data, can be interpreted as fuel for further rallies and as a sign that all the good news is already priced in. It really shows the inherent complexity.
So who are the optimists, the bulls? What's their case for gold continuing to climb even higher from these record levels?
Okay, on the bullish side, you have experts like Nikki Shields, head of research at MKS PAMP, a major Swiss gold refiner. She predicts a gradual bull market could continue, potentially reaching $3,600, met $100 above the current peak, with maybe an annual average around $3,200.
What are her arguments?
Compelling ones. First, a potentially weakening U.S. dollar, partly due to U.S. tariff policies maybe driving a move away from dollar dominance. Gold becomes a stronger alternative. Second, loosening global fiscal discipline, including in the U.S., coupled with record money supply, increases the relative value of physical assets like gold.
Okay, weaker dollar, more money printing. What else?
Third, institutional investors are increasingly demanding gold as a hedge against a weaker dollar and broader market uncertainty. And she points to pressure on the Federal Reserve to cut rates as a significant tailwind. The market's already priced in about 2 Fed rate cuts. More could intensify gold buying.
That makes a lot of sense, especially the hedge argument. But what about the other side? Why do some experts think gold could actually drop back down towards $3,000? Who's bearish?
For the bearish case, look to Rona O'Connell, head of market research at StoneX. She forecasts a decline towards $3,000 by the end of December, believing there won't be new highs this year.
And her reasoning?
Her core argument is that many supporting factors, geopolitical risks, U.S. rate cut expectations, central bank buying have already been priced in during the big rise from late 2023 to early 2025. Basically, the market has already factored in much of the good news.
So the rally already happened.
That's her view. She also suggests uncertainty over U.S. tariff policies is largely priced in, as countries like China and the U.S. ultimately need each other as trading partners, limiting extreme outcomes. Plus, while U.S. debt is a factor, the recent passage of a major tax cut and spending law in July means one major fiscal uncertainty has been eliminated, removing a factor for further rises.
So the optimists see more room to run, while the pessimists think the good news is already baked in. Do they agree on anything at all?
Interestingly, yes, they find some common ground. Both experts acknowledge that the pace of central bank gold buying, which was a huge factor recently, has slowed down.
Okay.
However, they both still see these purchases resulting in net positive inflows. That provides continued underlying support for the market, setting a strong floor probably around that $3,000 level.
So maybe limited downside. And what about other metals?
They also note that silver and platinum, being cheaper, might actually see even larger percentage gains than gold itself if the precious metals bull run continues. Investors might seek relatively undervalued assets in the same sector.
That's a really clear breakdown of the two sides. It highlights how many different variables go into forecasting gold prices. Now let's wrap up with a quick look at some specific company news, a kind of micro trends, macro impact roundup. What else should we be aware of today?
Okay, a fast-paced look at some key corporate movements showing the diversity of Japan's economy. First, Ito-En, the beverage company.
Ah, Oyoka green tea.
Exactly. They reported a 29% net profit increase in May-July, driven by the surging popularity of that tea, particularly in North America and Southeast Asia. Savvy marketing tapped into global health trends.
So green tea is going global. That's a great success story. What about industrial companies? Any significant moves there?
On the industrial front, Osaka Titanium. They supply high-performance titanium for critical aircraft parts. Their stock surged about 40% in just 4 days.
40%, why?
Fueled by intense optimism about growing global aircraft demand, sparked by major Boeing orders. Investors were clearly looking past current weak earnings, anticipating future price hikes and capacity expansion, betting on the long-term boom.
That's a huge jump. Any other interesting stock movements reflecting unique market dynamics?
Yes, Life Drink Company, another beverage maker. Its largest shareholder fund announced plans to sell 20% of its shares, potentially $30 billion worth. That usually raises supply-demand concerns, right?
It can push the price down.
So to mitigate that, Life Drink swiftly announced its own all $1 billion share buyback, a proactive effort to manage investor confidence and stabilize its stock during a significant ownership change.
Smart move to try and stabilize things. What about acquisitions? Any major strategic shifts there?
Tokusu Togaku, already a world leader in ignition plugs. Their stock hit an all-time high after they agreed to acquire Denso's automotive plug business for $180.6 billion.
That's a big deal.
Huge. A highly strategic move expected to significantly boost future earnings and consolidate their position as a global powerhouse. Market dominance through acquisition.
And on a more unusual note, I saw something about a VTuber affecting a company's stock. That sounds incredibly specific and niche.
Indeed. It highlights the unique sensitivities of the modern entertainment industry, especially digital. Cover, which operates a popular virtual YouTuber agency.
VTubers, right.
Their stock declined amid speculation about a popular VTuber, USADA Pecora, potentially graduating or leaving the platform. It shows how reliant these companies can be on individual talent, even virtual talent. Speculation can quickly affect market sentiment due to concerns over future donations, merchandise sales, fan engagement.
That's truly niche, but fascinating how it connects to broader market sentiment. And finally, what about traditional retail like department stores? Any signs of recovery there?
Mitsubishi UFJ, the department store giant. Their stock rose sharply despite a slight 0.9% drop in August same-store sales.
Why rise on a sales drop?
Because the decline narrowed significantly compared to July, and there was strong performance in tax-free sales indicating inbound tourism return and robust sales to their top-tier affluent customers. This combination is sparking hopes for a broader recovery in the department store industry, suggests resilience in luxury and a potential rebound.
So these snapshots, from green tea's global surge to a VTuber's market ripple, and the strategic plays in traditional industries, they really underscore how diverse and sometimes unpredictable the currents in corporate Japan are.
Absolutely. They highlight how global demand, strategic acquisitions, digital trends, even social media influence can drive significant market movements. Paints a dynamic picture beyond just the big headlines.
As we've explored today, the financial world is a constant interplay of global policies, rapid technological innovation, and, well, deeply human elements, from the psychology of currency traders to the future of our food supply.
That's right.
What's clear is that understanding these interconnected threads, U.S. tariffs impacting investment, AI streamlining banking, the strategy behind digital currency, even those shifts in family business governance, it's more crucial than ever.
Keeping an eye on these very developments helps us not just understand the news, but maybe anticipate what might come next, and how it will ultimately affect our daily lives and our financial futures.
Thank you for joining us on this deep dive into today's most important financial stories. Remember, staying informed is your best investment.